Hello everyone and welcome to your Glassnode video report for week 37, 2022. So we've seen the market trade down to the second lowest low in this bear market, about 18.5k, and then has since rallied. At the time of recording, we're up above 22,000. So when you get these very sharp moves during a consolidation range, they actually offer us a huge amount of information that a lot of people haven't actually found that edge. We can look at the amount of supply that swaps between being an unrealized loss to an unrealized profit or vice versa during these price moves in consolidation ranges and actually get a really good gauge for how much supply has been accumulated of late. So it's a really powerful tool, and I want to basically step you through this from a number of angles, not only looking at from the aggregate market, but then also breaking down into long and short-term holders where we can gain that little bit extra insight. So as I mentioned, we traded down from the range high of about 24,500 to 18,500, which is the second lowest low. And the way to think about that, we've gone from the top of the range to the bottom of the range, and therefore all of the coins that last transacted in that zone moved down from being in a profit to being in a loss. So we can actually look at that changing profitability of the system during these sharp drawdowns or rallies to actually assess how much supply is in that particular realm. And we can use that to build up both risk models. We're going to see that if price falls below that, that's going to become resistance, but also it shows us where the pockets of demand are, where are the price zones where there is a huge amount of coin volume changing hands. So we're going to start very high level and assess the damage so far in the 2022 bear market, just give a bit of context on where we are, look at things like cost bases and overall where the overall constituents of the Bitcoin space are. We'll look at these rallies and the impact on supply profitability. This is a really core concept and the one that I really want people who are watching this particular video. This is the one I want you to take home because it's probably one of the most powerful tools we can use, particularly during consolidation ranges. Now we'll also move on and look at things like profit and loss ratios, SOPR metrics, and I'm really going to target in the report. We look at a lot of long-term and short-term ones, which we have in our professional tier. I'm going to focus actually on the tier 2, the advanced metrics. So more of you can actually use these tools and actually deploy pretty much the exact same concepts, just looking at a different subset of the market. So I'll explain how we can use those different tools, and I'm going to put a lot of emphasis on using those advanced level metrics. And then the last thing I want to close out on is looking at the spending of about 5,000 BTC transactions that occurred by a whale over recent weeks. And the reason why I want to highlight this is we've only seen 11 instances in history where coins aged 7 to 10 years of this size have been moved. There's only been 11 times, and 3 of them were in the last 2 weeks. So I really want to highlight what actually happened and just explore how we can use some metrics to essentially check off and find out where those coins went. So as usual, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. And let's get stuck into the action. So starting with our price action, I won't spend too much time here, aside from really highlighting that we set this low, about 17,500 back in June. We since traded up to a high of 24,500. So all of the coin accumulation that occurred during this time has essentially moved back into profit. And we then traded down to 18,500. Not quite the lowest low, but definitely the second lowest low of this bear cycle and well below the bottom of this range. So what we get to see during this process is how many coins went from an unrealized profit to an unrealized loss. This is a really important concept. It's where on-chain analysis really gives you the edge to understand what's going on, and we can use that moving forward. So we'll come back to that concept later on. So just to start, I want to kind of set the scene with some big picture views, just so you can see where we are in this bear cycle, a bit of a roadmap on where we've been and where we could be going. So to start with our drawdown from all-time high, we hit about 72.5% as we traded down to 18.5. And you can see that it's more or less on the same order of magnitude as March 2020 in terms of the actual drawdown from that high. It's not quite as bad as what we saw back here in 2018, but over time we do actually see that we are seeing slightly lower bottoms over time. So if it was to start forming a bottom through this zone, it wouldn't be a surprise, but also keep in mind it has been worse. We have seen capitulation levels get down to 85% drawdown. So we're kind of in that middle ground where it would be nice to establish a floor here, but it's also not unheard of to see further downside. Now we're going to start with the MVRVs. What MVRV stands for is market value or spot price to realized value or realized price. So it's the ratio between what is the current spot price and what is the cost basis for a specific cohort of users. So the standard MVRV is for the entire market. The red one that we have here is for short-term holders, people who purchased their coins in the last 5 months. They are statistically the most likely to spend their coins. And the blue one is then the long-term holders. Note that the long-term holders realize much larger profits during the bull than their aggregate market and short-term holder counterparts. So these guys are people who've held their coins for 5 months or more, and they are the least likely on a statistical basis to spend their coins. Now, notice that during bear markets, these tend to collapse down very, very close to each other. See how during bulls, long-term are realizing huge profits, or they have huge profits ready to go. And what we see is it collapsing down towards the bottom of the bear. Same thing has happened recently. We've seen a collapsing down of profitability of everyone pretty much down to a level of just below 1. So currently the spot price is below the cost basis for the entire market, which is in orange, the MVRV. It's below the cost base of the long-term holders, and it's below them of the short-term holders. So all of these groups are currently underwater on their holdings. Now, with any kind of significant price push higher, as we rallied up above 22,000, we actually are now above the realized price and the long-term holder realized price. So we're starting to get to that point where we're tussling around their cost basis. Now that has often signaled a level of resistance because people want to sell to get their money back. They want to exit at their cost basis. They've seen so much of this bear, they've had enough. So it really is an important phase to actually break up and through those levels convincingly and hold it. And you can see these purple zones here. Let's zoom in on our current price action. You can see that we spent overall about 56 days below these realized levels. Normally we spend an average about 190 days. Back in 2018, it was something about 6 months. So we're kind of in that realm where we haven't been down here as long as previous cycles, but also history doesn't have to be exactly the same, but we will see how that plays out. So we did meet resistance on that first push higher and we got hauled back down below it. We've now poked our head back out above these realized price levels. We have to see if the market sticks the landing or if this is yet another underside retest that gets pushed back down. So we're kind of at a decision point here around 22,000 and we'll see how that plays out. Now, another very interesting dynamic is that normally the short-term holder realized price, the average price which was last purchased in the last 5 months, typically is quite close to spot. It makes sense because within 5 months, price is never really that far away. We're kind of in that same realm, and a lot of those coins are heavily weighted towards, less than 1 month. So it makes sense that short-term holder cost basis will follow price. And you can see this. Note how the red curve typically follows price all the way through. Long-term holder cost basis is much, much lower. It tends to take a long time to respond because after 5 months, Bitcoin's price is gone who knows where. After 1 year, it's even further away. 2 years, very, very unlikely to be at the same price of acquisition. So we can see these large deviations tend to occur. Now, these purple zones, note here, this actually we'll zoom in on the last couple of bear cycles so we can actually see it. Note that these purple zones is when the short-term holder cost basis dives below the long-term holder cost basis. It can be down there for some months, but the reason why this happens is that long-term holder cost base is a very slow-moving beast. It represents what was the acquisition price of all coins on average that are older than 5 months. Now, the short term, as we mentioned before, tends to follow price. So when you get the diving down below the long-term holder cost basis, this means that a whole stack of coins were recently moved within the last 5 months to a price that was more advantageous than the long-term holder average. Meaning, if you had bought within the last 5 months, you are better off than any of the people who've held their coins for more than 5 months. This normally happens after capitulation events, late stage bear cycles, when a huge amount of coin volume has been distributed down to a single level near the end of the bear. So let's zoom in on our last 5 years. And what you can see is that we crossed over back here in 2018 following capitulation and we're down there for about 4 or 5 months. Here we are on the verge of a crossover. So again, aligning with that duration topic we said before, we're about to get a crossover. It probably will happen sometime around mid-September or late to mid-September. We'll see how this plays out, but it's only a couple of days away. if we do see that process take place. Now, from that, historically speaking, that kind of puts about 3 to 6 months worth of possible duration. That it doesn't mean it has to do that, but in previous bear cycles, that's what we've seen. We have the capitulation event, and then we have a series of months as the market reaccumulates and goes through that digestion of the move to the downside. So we'll see if this crosses over coming days. And what that would generally signal is that potentially there's some duration ahead. So there's a few pieces of evidence that kind of point to we've done about 56 days down here below the realized price. Historically, it's about 180 days. So somewhere on that duration time, we may be just lacking that time component so far for the market to digest this system. But then we must also, of course, factor in the macroeconomic space, which is variable and challenging to read at the best of times. So all of these things are playing in amongst themselves at the same time. So we're now going to look at short and long term and also supply and profit. This is the concept I mentioned earlier and the one that I really want to pay attention to. So I'm going to start by actually looking into some of these on the large scale chart to give us a bit of playing space and just understand what's happening. So what this is showing is long-term in blue, short-term in red, supply that they hold. So this is the unspent supply in loss. Now, the first thing I want to highlight is that long-term supply is roughly at similar levels we see near deep bear market cycles. We are at the phase where as much supply is held by long-term holders in loss as we see in previous cycles. You can see that the total height of this is actually quite similar across the board for both, combined long and short. So we're now at a position where on a percent supply and loss, the long-term and the short-term holders are at a very similar level to previous bear cycles. They currently hold about the same amount of supply underwater as in previous cycles. My read on this is it looks like the amount of damage that's been done. We have a similar amount of financial pain currently in the system that we see near bear market lows. Now, bear in mind that we can see this go higher. As you can see, this is not the highest reading. In fact, it's one of the lowest readings of all bear cycles. So it aligns with that first observation we have where we could have a leg down lower and it would still be well and truly within typical bear market behavior. So that risk does remain. Couple that with the duration pain that we haven't yet seen, and you've kind of got a bit of a recipe for just be prepared in case there is another leg down, because it would well and truly be within historical norms. Now, this is the metric that I really, really want you to take away. I think it's massively underutilized, and it is the percent supply in profit. Now, I will normally get this specific metric out for two different tools. One, you can clearly see the macro shift between everyone's in profit having a great time in the bull to nobody's having a good time down here in the bear. So up here, 100% of the market's in profit. Down here, sub 50%. So, I mean, this is 42%. So that means that 60 odd percent of the market is in a loss. So it's good for the macro scale, normally with some kind of moving average like a 30-day or something like that. But the other thing I use this for is for consolidation ranges, and I'll show you what I mean by that. I actually want to zoom in on our current 2021 to 22 cycle. So there's two instances here that are really, really powerful. The first one is back here in May 2021 through to July 2021. We had about 2.5 months of sideways to down consolidation. During this time, people who bought the top, people who bought low and were actually panicking, all people from this cycle are selling coins out of fear, taking what profit they can. Coins accumulated in this zone in a very, very big way. So during this consolidation, and the longer it goes, the more powerful the signal I'm about to describe will be. The longer that this goes on, more coins get shuffled down into this price range. We trade from the low to the high to the low to the high, and during that time, people are distributing coins. Note that our percent supply and profit is volatile, it's moving around, it's hard to read. But then note what happens as we rally from the bottom of the range at 29K simply to the top of the range at 38. Here's the top of the range. We're only at the top of the range. All of this price action is a range. But look how significant the move. It went from 67% supply and profit all the way up to 77% supply and profit. So on a rally from 29K to 38K, which is just this range, this jumps by 10% in supply. What does that mean? That means that 10% of the supply at the bottom, all these coins are in loss. At the top, all of those coins are back in an unrealized profit. That means that about 10% of the overall Bitcoin supply was accumulated down here in that range. It also means that 10% of the supply capitulated and someone else stepped in and bought those coins. And they have a much, much better cost basis. So we can use that tool to say, okay, I've got 10% supply here. That shows demand. It also shows a risk. If we had a sold down much lower, let's say we rallied up and then it failed and we dropped down to a new low, which by the way, we did in our recent leg, that tells you there's about 10% of the supply that's trapped up here and it becomes a risk. So it's both support and resistance depending on which way price goes in response to that. So the key thing, look for very big moves in percent supply and profit up or down during a very relatively small price move. So let's bring it across to our current market cycle. We have seen about 3 months of consolidation within this range between 17.6K and 24.5K. We traded down to pretty much the range low. You can see that aside from this very, very bottom wick, which, okay, who cares? All of this price action is contained within this move. And we traded down from, let's say, 64.5% all the way down to 48.8%. So we can see how many coins fell back into an unrealized loss from profit to loss. And then we had our bounce up to 22.2K and we've pushed, look at this big vertical move. There's a huge pocket of coins hovering just down here as their acquisition price. So again, that tells us there is demand, there has been capitulation, it could be support as long as price is trading higher because we know that demand exists. If we trade below it, that's where it starts to get a bit scary because then you say we actually have potential resistance. So again, we don't know what the future holds, but at least we can now measure from the bottom to the top how much supply is in this realm because it changed from being in an unrealized loss to an unrealized profit or vice versa. So you're looking for big changes in this metric on very small or relatively small price changes. And it's really, really powerful in consolidation ranges to just gauge where are all the coins. So hopefully that was a useful little exercise, and it's a powerful tool that not many people are using, and percent supply and profit is a really, really great tool to actually map this out. And if you want to flip this around, in Workbench, you could do a 1 minus percent supply to do percent supply in loss and do it from the other direction. So now I want to move into some oscillators that are also really powerful. And again, these are all going to be T2 metrics. What we have here is the realized profit to loss ratio. So the realized profit to loss ratio is looking at all the coins that were spent. Some of them are going to be realizing a profit. Some of them realize a loss. Let's compare them in a ratio. So naturally, during bull markets, this thing will go green, and the higher it is, the more profit there is relative to losses. Vice versa, the lower it is, the more losses there are to profits. And as you can see, we have come down and hit during recent sell-off in June. We came down and hit not the worst, but pretty close to it. We are absolutely in deep bear market territory. We've seen the amount of loss is quite significant for the period of the cycle that we're in. Now note that we came back up and almost broke above 1. We didn't quite get there. This is on a 30-day moving average. We almost got there, and then there was too much profit being taken. The market couldn't sustain it, and it sold off. So this is essentially the more profits are being taken on the rally higher. People basically bought the dip, sold the rally, and we've then since pulled back. Now, this is a metric that I'm looking at in terms of putting an alert on. If we break above 1, generally speaking, when we get above 1 following a deep bear market trend, it signals some kind of recovery. So a really nice break above 1 and then a retest is a good sign. It pushes us back into more bullish territory, shows that profits are being taken and the market can sustain those. Now, you can see here there are some false signals, so just be aware you're looking for a break above and then a retest and then a move higher. The other thing to observe is note that during this 2015 bear had the lows get higher and higher, ascending lows. Same here in 2018 and 2019, ascending lows. That's saying that there's at the lows, there's less losses, and at the highs, there's more profit, which again is signifying that we're getting that better cost basis. More people are in profit, more people are able to trade it successfully, and we start to, it takes time, but the market eventually moves back towards that more constructive trend. So you can see here, we've been down in this phase in 2018 for a number of months. Here, we've been down here for about half that time. So there's still a process to go. We're not out of the woods yet. There's still time, but you can see that there's a gradual uptrend. If this sets a new low, a new higher low and starts pushing up, then potentially we're getting that improving profitability over time. Now we can actually see a very, very similar pattern in our SOPR metric. So SOPR is think about like a profit multiple. A value of 1.1 signifies that on average, people locking in 10% profit, and 0.95 means they're locking in a 5% loss on average. Very similar as we come out of the 2018 bear, this uptrend signifies improving profitability. It takes time. We break above one, we get the retest, and then we move back into more bullish territory. March 2020, improving profitability, break above one, back into more bullish territory. Here we are, we had an underside retest, we got rejected back down, but we're starting to develop improving profitability. So aSOPR is another one. I've got a 7-day moving average on this one applied. We want to see a sustained break above one, nice retest, and then a bounce. You can see that in previous cycles, sometimes it takes a few attempts. Sometimes it's not the first time. It takes a process. These bear markets take time. But these are some of those things you look for confluence. Do we have lots of supply that's now back in profit? Do we have aSOPR breaking above one? Do we have our profit and loss ratio breaking above one? And if you put these on something like a 7 or even a 30-day moving average, you add that confidence. This is a macro trend shift rather than just a short-term noise. The smaller your moving average, the more daily noise, the more your moving average, the slower it will be to react, but the more momentum is there when it actually does happen. So returning back to our dashboard, let's cover the very, very last thing. What we saw over the last couple of weeks was, you can see here, 1, 2, 3 transactions that contained about 5,000 BTC. Now, these only happen, there's only been 11 instances. These are 7 to 10-year-old coins. It's only happened 11 times in all of Bitcoin history. Obviously, they can't happen until Bitcoin is at least 7 years old, so keep that in mind. But we've only had 11 of these in history, and 3 of them happened last week. Now, we went through, and I'll leave the gritty details into the report, which you'll find in the description below, but we actually went through and tried to assess where did these coins go. And we had our data science team look into it, and at a very high level, we saw that these 3 coins have very similar patterns. They were all accumulated back in December 2013, which we go back and look at the chart means they actually somewhat bought near the top of that 2013 cycle. That said, Bitcoin prices are about $543, which none of us would snuff at today. So between all of these, we established that of the 15,000 BTC that were moved or thereabouts, about 8,500 of them were directly sent to Kraken. And we're continuing to look and see where these coins went. But overall, 8,500 coins we know went to Kraken. So if you actually look at the realized profit multiple on those, 8,500 coins that we assume were sold, they don't have to be sold, but we assume that they were transacted from December 2013, and they realized an aggregate profit of about $163 million between those 8,500 coins. Not a bad little trade. Quite interesting when you see these whales start to bring their supply back to life. 5,000 coins is clearly a significant amount, especially for that time frame. They are some serious diamond hands. So $163 million in realized profit. Quite a remarkable thing to see. And it's nice because we don't get to see them very often. So when we finally do, we can explore them on chain and use this data. So here what we're looking at is the spent volume lifespan, 7 to 10 years. Here we have the transfer volume to exchanges in BTC for Kraken. And you can see we have our 1 and our 2. Here's our 3,500 and here's our 5,000 BTC. So we can actually track down where those coins went and line those up. So thanks everyone for tuning in. Hopefully you found that useful. Please let me know if you enjoyed going through in a bit more detail that concept about percent supply and profit and how we can use those ideas. This is the type of content that we're producing in our Glassnode forum, which is really focused on giving advanced and our professional members those extra tools, those extra insights and concepts alongside workbenches that we really explore how and why we built them. So trying to give everyone who's within the Glassnode community a bit more edge, a bit more detail, understanding how we can use these metrics and really pull the most out of the Glassnode suite. So hopefully you enjoyed that, and I will see you in the next one. Cheers.